Hi guys, it's Ted and my fellow degenerates. We will be starting with our first video for the cohort. It's the introduction to financial markets and quantitative trading. Yeah, so the start is the reality of financial markets. Most of you already would have learned about it. The fundamental drivers of price, that is the volume, institutions, retail traders, just like you and me, right? But just like you and me, others will be making losses and we will be making money. What is a market? It's some mechanism for matching buyers and seller to find liquidity, and there are a lot of asset classes like equities, forex, derivatives, cryptocurrencies. We will be covering in the start of the cohort about two types of common strategies, one being momentum based and the second is mean reversion. Yeah, so before I yap more, let's start with trading view. How do you identify what's a momentum based asset class, how to choose an asset class that is better for momentum, and how to choose an asset class that is better for mean reversion. So let's take example of Bitcoin. As you all might know, it's highly volatile and it started from in 2020 around 20,000. It pretty much made 6x at 120,000. And let's just remove these indicators for a while. This is just to show you I don't trade with this shit. Yeah, so this is momentum based, high volatility, basic high upside and downside. And then let's discuss mean reversion. What is mean reversion basically? So for mean reversion, it's like you see this band, price is just like this band. You overextend it to one side or the other side and it will snap right back. It's like a oscillator, or it works like an oscillator. RSI is an oscillator. So just like that, mean reversion, let's say the price went from this to this is where it got overextended and it fell right back to the fair value that the market thought it should have, and yada yada, continues on doing that. So for asset classes that works on mean reversion, forex, what could be a better example, right? The daily movement is no more than 0.1 0.2%, but in some certain scenarios, like there is a macroeconomic factor, alternative news that is coming in, geopolitical situations that might lead to huge volatility in forex. But that huge volatility in forex is only like 0.5 to 1% max. Yeah, so continuing to the quant philosophy versus discretionary trading. What is discretionary trading? Discretionary trading is when not you are the smart ones, but the dumb fucks, when they think, let's see, yeah, they will follow a guru, or they will think of drawing trend lines or looking for volume spikes. Yeah, volume spike, huge red candle, let's short, but it goes up the next moment. So trend lines and all that crap don't work out. It just doesn't. And for the ICT SMC believers, yeah, that shit also does not work out. And you already know that. That's why you're here, right? That doesn't work out. Yeah, talking about the quant philosophy. You being a human being cannot sit more than 8 to 10 hours on a screen watching charts. You will get mind fucked. Systematic solutions, it can work when you are sleeping, when you are eating, when you are taking a shit, doesn't matter, it can work out. Yeah, the mathematical edge, what we look for as a quant, the job of a quant is to generate positive expected value, the formula of the expected value. And let's say, let me talk about the limitations of manual backtesting. So you might be able to backtest, let's say, 1 year data, 2 year data on higher time frames. If we break it down to lower time frames, 5-minute data, you might be able to backtest for what, like 4 months, 6 months. You think that will tell you how to trade, that will tell you different market regimes, or if your strategy is profitable or not? No. So that's why in quant, if you can manage to get data, you can backtest for 20 years, you can backtest for 40 years, you can backtest for 1 year, up to you, entirely up to you. Let's break down to the anatomy of a quantitative strategy. Data acquisition, pretty obvious. Level 1 data is OHLCV, that is open, high, low, close, volume. Yeah. So whenever I say OHLCV, I hope you then understand what I mean by that. Alternative data sources being sentiments, macroeconomic indicators like non-farm payrolls, CPI, GDP growth, things like that, So what we focus on is the alpha generation. A few of the things that I look out for is, let me show you. Yeah, right here. So basically this is buy and hold, right? Yeah, let's extend it till, let's say here. So if you had bought it in the start of 2024 QQQ, that is Nasdaq ETF, you would have made about, if you had held till now, you would have made about 54%. But as you can see, if you had held it, even after 1 year and 3 months, you would have negative returns because of the huge drawdown that it had. So what me as a quant, for advising retailers, what I would suggest is either you focus on beating buy and hold, or focus on drawdown, minimizing drawdowns. These are the two major stepping stones for me. But at the end of the day, it's the mix of both that creates a profitable strategy. But you should always keep that in mind, that these are your objectives. And then there comes Sharpe ratio, Kalman ratio. We will discuss more about that later. So risk management, Kelly criterion. I will teach Kelly criterion in a reel, I think. Execution, translating the signal into live market. So you make your code, you backtest it, you ensure there is no common quant mistakes, and then you upload it to a cloud server, let's say AWS, Oracle Cloud, and then you take it live, so it trades for you. So coming on to the point that I was trying to make with these shitty indicators, SMA crossover. Let's say you are still a believer that, yeah, this might work out. So let me show you. Let's say I tweak the settings 5200, let's make it 5100, and I believe that, yeah, this will make me money. Common mistake, this won't. Loss. Well, you might say that you should shift to a different asset class. Let's do that. Loss. Ta-da. It doesn't make profit. Simple. It's just that simple. Market, you might have heard about the efficient market hypothesis. It says that everything that you might get aware of on the day of let's say when the news comes out, the efficient market hypothesis says that the news has already been factored in by the insiders, by the market, into the price of the asset. So let's say if you think, yeah, I will tweak the settings, I will maybe anchor SMA to close, open, or even change it to EMA, that doesn't work out. Why? I will share a research paper as that for this. If it's like, how do you know what combination of lengths of SMA EMA might work? You can't. And if you are thinking that you will backtest it over 10 years, 20 years, and you will see, let's say 23 and 39 is the best combination for SMA, why would it repeat? Why would the historical pattern repeat itself? It might have worked out well in the past years, but there is no statistical possibility that it will recur in the future. So that's why we have a lot of methods to make a robust strategy. We will go on with that as well. So ending with my personal suggestion on how to go from A to Z in quant. Keep in mind, I'm saying this like how I would start or how I would do it over again. But each person has its own existing skills, capabilities. So if you already know things you might skip out. I know a few of them, but yeah. So what I would do is I would start with research papers. The research papers I would start with is definitely CMT. CMT is chartered market technician. It's a chartered code just like CFA, FRM, but for stock market traders. I would start with research papers. Let's say I would start with ranked asset allocation. I would start with anti-fragility asset allocation, and I would try to reverse engineer them. I would try to decompose each concept of the paper, and I would try to reverse engineer them on my choice of asset. This helps build asset behavior, understand asset behavior, and build intuition. Now, of course, you will make many mistakes as a beginner. You will have look ahead bias, you might have shift error, you might not account for slippage, commission, spread, and then you might also have data leakage, unaccounted data leakage. With that, you will hit brick walls and your models won't work well, but that's where we come in. Me and the community, we will help you out with that. And parallelly, after a few months of understanding the rubrics, the basics of quant, I would start with basic calculus, linear algebra, stats and probability, specific application in quant world. But if you are somebody who is looking to get a job in quant, you should definitely go through in depth of those mathematical concepts, because that will be asked in your some random probability question will be asked in your interview. Then I would continue with papers. Me personally, I study from 4 to 5 papers every week on quant finance. It could be risk management related, portfolio construction related, it could be in depth like econophysics, econometrics, anything, but at least I will read about it and try to learn from it. There is a lot of alpha that you can generate just from looking at research papers. And all of you degenerates that will ask me why they publish the research papers, now hedge fund will factor us out, they will know what we are trying to do. No, that doesn't work like that. The alpha decay is there after a publication is done, but I think there is not a major alpha decay on macro time frames, higher time frames, that is 1 day, 4 hours, 12 hours, 8 hours. So in the start, when you're beginning your quant journey, you should majorly focus on higher time frames. Definitely don't expect that HFT, we will do HFT. How will you have the infrastructure, how will you have the data for that? There are a lot of tippity tappities that goes into that. We will get into the depth of that later. So that will be all for the first video of the cohort. Thank you so much for joining in, guys, and I hope to add value and help you break the loop of endless buying fake gurus, ICT, SMC, change of character here, breakout structure. Stupid. That's just plainly stupid. Throw that away. Just flush it out of your mind. Yeah. Thank you so much, guys, for your time.